What exactly did the Monetary Policy Committee of the Reserve Bank of India do yesterday? It did not change any rates. It held everything the way it is and just said that it remains accommodative. But there has been a storm of debate and discussion since then. The debate and discussion is that the RBI seems to have missed an opportunity to tackle inflation. Nobody was expecting the central bank to raise interest rates, which is called the repo rate or the key rate. But there was a huge expectation that the RBI would increase the reverse repo rate, which is the rate at which banks park money with the central bank. Although that is not the remit of the Monetary Policy Committee, this was an opportunity for the RBI to raise those rates and reduce the money in the system to be able to tackle inflation. But the RBI has done something else, and that is the topic of our conversation today. And that is something Ila Patnaik called it a risk in her column today. I'm YP Rajesh, managing editor at ThePrint. Hi, Ila.
Hi.
Let's start at the beginning, like we always do. You were surprised?
Absolutely. I think everybody in the market was surprised. So, when you look at the background and why we were surprised, what's been happening for the last 2 years all around the world is that fiscal and monetary policy were both in stimulus mode. So you had expansionary fiscal, you had expansionary monetary policy, which means governments were borrowing and they were spending because the pandemic had hit all economies. At the same time, interest rates were brought down, liquidity in the economy had been increased so that people are able to borrow more. Not that there was that much demand for credit, but there was this hope that if credit is available cheaply, then people will borrow more and therefore help revive the economy. Okay. In that background, in the last few almost months now, with an increase in demand coming both from monetary and fiscal policy, when in a situation when actually supply was constrained, right? There were supply issues at that time. Prices started rising up. Inflation started going up, not just in India, but everywhere in the world. So the way policymakers have responded to that, the way central banks and monetary policy committees have responded to that is that, okay, now it appears that the pandemic is coming to an end and we need to start normalizing policy. Okay, we need to start normalizing fiscal policy or monetary policy or both, because now we have a risk of high inflation. With that in mind, a lot of central banks have already either indicated that monetary policy will get normalized, or they have already started raising rates, like the Bank of England. And they have started taking steps to reducing the extent of liquidity in the system. RBI was also expected to do that, particularly for two reasons. One, that inflation has gone up, and so it is worrying that inflation has gone up. And second, that they have actually started tightening a bit. So because they have actually started tightening a bit, what you expect is that when there is a monetary policy committee meeting, then the RBI would give out a signal that we will say what we do. So, normally we talk about we will do what we say, but they were already doing something. And so now they had to say it. And that saying that meant that, look, we are transparent. Our job is not to confuse markets. That's not our prime responsibility. Our prime responsibility is actually to manage expectations. But, in the past, many times, we've seen this thing where RBI says one thing and does another thing. And unfortunately, this was another one of those episodes. And that's why it has created a lot of shock, surprise, debate. And what's going on? When you were
Mhm,
already tightening, why are you not saying that you were going to
mhm.
tighten further?
So, one of the assessments is that the RBI finds economic recovery to be fragile still, so that is the reason it is holding rates. Would that be a correct assessment, Ela?
My sense is that the decline in investment that happened in the last 2 years particularly happened mainly because of the large uncertainty due to the pandemic, both globally and domestically. We didn't know. We thought it would be one wave, but it was
Mhm,
a first wave and then a second wave and then a third wave, and restrictions that had to be imposed. All of us almost getting COVID, and the kind of uncertainty that that created is what affected investment. So investment was low, not because there was an issue with interest rates, not because of the issue of cost of capital. The issue was mainly, of course, demand was low. There is, that goes
mhm,
without saying that during this period, demand was low. But the second thing is also the huge amount of uncertainty. So when you try to find a solution to anything, you first look at what is the problem. And then you address the solution has to be part, keeping that in mind. Now,
mhm,
in this case, will a indication that when things normalize, we will also normalize monetary policy, we will try to control inflation, and basically managing those expectations would have meant maybe a 25 basis point hike in the reverse repo rate,
mhm, mhm,
or just the central bank governor in his speech saying that, look, we are mindful of this and that we will normalize, and to give a
mhm,
signal to markets that we will keep inflation under control. Keeping inflation under control is important, not just because uh, saying that you want to keep inflation under control is important, not just because you actually bring inflation down, but it is also important because it tells the public, tells observers and markets that the RBI is committed to the mandate that has been given to it, which is of inflation targeting. So to remain credible,
mhm,
that's what they needed to do.
mhm. Uh, One of the objectives is clearly to keep the government's cost of borrowing low, is what you have written. And it is also about the RBI focusing more on growth this time and less on inflation. Again, is that a valid assessment?
Well, YP, actually, I think they're not focusing on growth as much, because as I said, I don't think growth would have been affected by a 25 basis hike in the reverse repo, which is already happening. Okay, because
Mhm,
already you're pulling liquidity out. I think they're focusing on trying to keep the cost of government borrowing low,
mhm.
and that is because they are still the debt manager of the government.
Yeah.
So we've been talking about setting up an independent debt management agency,
Mhm,
that there should be a PDMA, that RBI, like most, I mean, all other countries, I think, other than Saudi Arabia and China, but almost all other countries around the world have now got a separation of debt management functions
mhm,
away from the central bank, precisely because in situations like this, when you have conflicting objectives, when there is a large fiscal borrowing program, and you have to try to, as debt manager, you have to try to keep the cost of government borrowing low, while at the same time there is inflation in the system, and you have to try to keep inflation down by increasing interest rates. There is a clear conflict of interest, which is why you needed to RBI not to be the debt
mhm,
manager. That function had to be taken away. But then, in its wisdom, the parliament decided that it would not do so. And now I think the next, this episode, this
mhm,
coming year, is going to actually bring out this conflict and pose a problem for policymakers.
mhm, mhm. You have said, Ila, that the RBI's projected 4.5% inflation for the next financial year seems to be too optimistic. Why do you say that?
See, global oil prices are rising. Demand has been increased despite supply constraints. Imported inflation is high. Now, at a time like this, the MPC is typically dependent on RBI for its projection. So if you say that inflation is going to be low, and this is an unconditional, forecast, not that if we raise interest rates, then inflation is going to be low. Not that if we normalize monetary policy and reduce liquidity, then inflation is going to be low. No, we'll keep liquidity high because we are concerned about growth, and still on its own, inflation is going to be low. Right. So when you make a projection like this, basically what you do is that you influence the decision or the judgment of the Monetary Policy Committee members. Now, unlike some other central banks where actually there is a research team that does these forecasts to which all members, including external members, have an access. That is not the case in RBI. So it is, the research team that does these forecasts works for the RBI. It's not that external members say, hey, we think that, your assumption about oil prices being 75 rather than 90 is unrealistic. That's what an MPC, external MPC member should be able to say, that, look, I think, it could be any point. I'm just giving you an example, that it could be any point where they could say, look, I disagree with what you're forecasting for X, Y, and Z, and therefore I disagree with your forecast. Now, when that is not the situation, and if RBI wants to fulfill its role as debt manager of the government and keep interest rates low, I'm not surprised that their inflation forecast is unrealistically low.
This whole focus tells us that the RBI runs the risk of falling behind the curve in managing inflationary expectations. And the other curve everybody has been again talking about today, Ela, is that the RBI is falling behind the global curve of monetary policy, which we talked about, where other countries are raising rates to tackle inflation. And India is sort of, is it fair to say that we are decoupling ourselves from the rest of the world when it comes to monetary policy?
See, what happens in situations like this is that at the end of the day, the pressure is going to come through your currency. Okay? So you might think that, okay, we can have high inflation and we can be part of the world. We are part of the world. We have capital flows in and out. We have, in fact, the current account deficit might be a little on the higher side this time. So in a situation like this, you are taking the risk of higher currency volatility. So because, somebody might believe you, somebody might not believe you. And so you remain less credible as being a tight inflation targeter. You could be talking of decoupling at a time when, suppose inflation rates in India were low. Let's say they were 2% and global rates were high. And so globally people were raising rates, right? And in India, we didn't need to. So that would have been a time to talk of decoupling. But when your own inflationary expectations are high and you're kind of pretty much going where the world, you need to go where the world is also going, then this is not a time to decouple. So I don't think it's either that they should have decoupled or that they are actually decoupling. I think the pressure will come through currency volatility, and then they can spend a lot of time trying to, they could either use some reserves, but then they never use too many reserves when there's a pressure on the rupee to depreciate. They step in and buy dollars. They're not happy stepping in and selling dollars. So they won't do a lot of that. Then they'll start tightening, in a very jerky manner and start really tightening and then hurt the economy. Whereas now, if done in a calibrated manner, it would not have hurt growth, which is why all other central banks are doing it in a slow, calibrated manner. They're not waiting for a crisis to then say that, oh, now we need to tighten. Now there is speculative flows, this, that, and, some excuse or the other, and say that, oh, we'll suddenly tighten liquidity a lot. because that's the time when it hurts the economy, not when you do it in a slow, calibrated manner and manage expectations. And I mean, we've seen this before, and we really, I mean, I wish that the RBI had learned its lessons from the past and had not tried this trick. I hope I'm wrong. I wish it doesn't happen, that we get pressures like this and that RBI gets into trouble trying to basically manage the impossible trinity during the year. But let's hope I'm wrong.
You never know. There is a question from Ishank Sagar. It's not a question, but actually he's making a point about rates. Ishank says, I don't think even 100 basis point increase would have made any difference. Banks are not lending to common people. People are not borrowing. So not sure if interest rate increases make any difference. You want to respond to that?
Well, I was only saying that they don't need to do 100 or anything of the sort. I just, so inflation, the job of the MPC and the central bank is to manage inflationary expectations. And yes, maybe he thinks 100 wouldn't have made a difference. I think 25 would certainly not have made a difference, but they would have helped in managing expectations. So it wouldn't have made a difference to credit because, as I said, credit demand was not happening because of lack of consumer demand, because of lack of investment demand due to the uncertainty. And that's why credit demand was low. So it's not the 25 basis point increase in a reverse repo rate, which already is, the market has already, moved along those lines. So that it had more to do with what I'm signaling, what I'm saying I'm committed to. And they needed to do that.
We have time for one last question, Neela, and that is from me. The RBI's growth forecast, the MPC's growth forecast yesterday, showed that growth will taper off towards the end of the next financial year, first quarter, second, third, fourth quarter. And the overall projection is lower than the economic survey forecast at, which is 7.8%.
Yeah.
It looks like the RBI knows something about growth than everyone else.
See, to be fair, in periods of high uncertainty, forecasts can vary a lot. Okay. When you are in a period of low uncertainty, suppose there was no pandemic, and everybody says, okay, 5.5, or whatever, there's 7, between 6.5 and 7.5. And you'll find that most forecasters are pretty bunched together, close to a number. Whereas what we are seeing here is that even between MOF and RBI, there is a divergence of the projected growth rate for the next year. And I would actually find it healthy because, these are periods of higher uncertainty. One makes certain assumptions, and on the basis of those assumptions, one makes a forecast. This is not based on information. This is not based on something they know. This is based on something they expect. And I mean, I've done macro models and assumptions, and, a very small difference in one assumption or the other can actually really make a difference to the forecast that one gets. So I think it's a healthy thing that during periods of high uncertainty, there is a lot of variation in forecasts.
In your column today, Ela, you said as a summation or a summary that the volatility induced by changes in Fed rates, oil price hikes, or any other shocks could induce turbulence in currency and money markets. One of the other perspectives I read, which sort of ties in with this, but it talks more about recovery and growth, is that excessive monetary policy accommodation for an extended period could end up undermining prospects of sustainable higher growth. Actually, it might end up hurting growth, is what this analysis said. Is that a fear we should be worried about?
Absolutely. And that's what I'm also trying to say. Maybe, not as well said as what you've read, but that's what one is trying to say, that if you don't, as I said, tighten, calibrate, do it at the right time, then you might get growth today, not raising reverse repo by 25 basis points today. if somebody thinks that it's going to get them growth today, then, let's
Mhm,
assume that they actually get high growth because of that today. But it creates all these risks in the system, that because one, you've lost your credibility. Second, people
mhm,
don't know what you're now committed to. Are you going to try and stabilize the rupee and jump in and try to do things at a time when there is volatility? And markets tend to then overreact when they don't know
mhm,
what you're doing. As in any relationship, as in any system, when I doubt what you're doing, then I tend to overreact, rather than, if one is comfortable, okay, yes, YP will
mhm,
be there at 4 o'clock every Friday afternoon. So we'll, expect. So I think this is absolutely right, that if you try to be, at the moment, you do too much of monetary accommodation, to be too
mhm,
accommodative at a time when you needed to start normalizing, you don't do it. Then when the time comes, you will move too fast, you will have knee jerk reactions, and you will actually hurt growth.
mhm. There is actually one question now from Ram Prasad Deshpande. We were just running out of time, but we'll take Ram Prasad Deshpande's question, Neela. And he says it's completely unrelated, but it's very important. So let's see if we can answer it. He's asking a question about when India will achieve a 5 trillion GDP that the principal economic advisor Sanjeev Sanyal said it's about 18 months behind schedule. We will give you a link to that interview in our links notes, Ram Prasad. So please read that one. 10 trillion economy, who can bet on that, Ila? Uh, 10 trillion economy.
YP, all these depend on the growth rate that we
Mhm,
achieve. So, it's not coming up with a number, coming up with a date. These are all
mhm,
forecasts that we are making. And in periods of higher uncertainty, I think these forecasts will vary a lot. So, whether I say that we are going to grow at 7, 8, 9, 10, or whether I say that, if I grow I will achieve 10
mhm,
trillion by such and such a date, it's the same thing. Basically, you're making a forecast about the growth rate of the economy. So, fortunately, I no longer have to do that job. I
mhm.
am not running models of growth rates. Sanjeev Sanyal and the RBI are. So you can take, suppose this gentleman believes the 7.8% growth rate. Let's say even if it's 7, then in 7, GDP will double in 10 years if the
Mhm.
economy is growing at 7%. Make your calculations depending on what growth rates you put in.
Yeah. Thank you so much, Ila. We have to conclude our episode here. Thanks to all our viewers who are watching. And the good news, if I may call it that, is next week we will be back in our office and we will be back in our studio and be able to do this outside of Zoom, talking to each other in the same studio. So we are looking forward to that, and we hope you will join us again next week with another new topic for Ila. Thanks for